All right, good morning, everyone. Welcome to kcstat. This is the second in our long series of aligning our kcstat sessions and also the PM meetings that feed up into this with the City Council strategic priorities that were adopted in resolution in November. So this session will focus on our finance and governance section of the priorities and the indicators that are aligned with that. I think our finance staff has done a great job of already having a lot of the charts and data created, so not as much work for Kate and I, so we really appreciate that. So if you want to, Andrew, if you want to
I would just kick this off and just by saying, you know, this is, as we undertake the strategic planning process for the departments in developing business plans and linkages back to council priorities, this is pretty much a foundational exercise. It's off of which everything else has to be built. So I want to stress that while this is kind of core foundational work of building that stability, that structural stability that will allow the departments to achieve their business plans and allow us to meet those council objectives. In many respects, kind of the priorities outlined here have to be done regardless of what we do from an operational standpoint, because this gets to the fundamental fiscal soundness of the city. So this is kind of the bedrock stuff that upon which all of the rest of the strategic planning, the performance management, the business planning, the council priority setting will take place. As we have to have a strong fiscal foundation. So we've done a lot of good work. We've got a lot more work to do, but I think we've got the pretty solid beginnings of a good story to tell, and we'll let finance walk through this. But and if we get a little too doom and gloomy, we'll try to figure out a way to. Because we do have good stuff to say, but it's just.
Well, I hope so. After the prediction of perhaps getting too doom and gloomy.
Mr. Mayor,
shall we start now?
Shall we start now? At the risk of being too doom and gloomy, I brought some backup with me. I know you know I know, so
I'll see you after the meeting.
You know, we should also mention, and
anyway.
So that begs the question: where's the real bottle?
That would be a violation of our drug and alcohol misuse policy.
They do not sell empty boxes.
We're excited to be here to talk about the financial foundation, and Mayor and Mr. Manager and Madam Chair and Mr. Co-Chair of the Finance, Governance, and Ethics Committee. We spent a lot of time working on this in the last couple of years, and I think what you'll see this morning are 5 broad goals that really sort of outline some of the things that we think we should work on to prepare the city's financial foundation so you can actually have the resources necessary to meet your strategic goals, which you'll go through over and over with all the other elements of the CityStat program. We spent some time over the summer working with the Chamber and the Civic Council, as you know, Mr. Mayor, and we actually developed, Julie mentioned earlier, this financial trends monitoring system. So I think we got a good jump start with regards to preparing the data necessary to sort of evaluate our financial condition and then enable us to start long-term financial planning, which will put together kind of the goals and strategies necessary to improve all the elements of our financial foundation that we think are most important. We took the broad goals and the strategies from that work over the summer to the Finance Committee. We had a work session, and the goals that emerge are the 5 that you're going to hear about today, which are broader in nature, but they encompass a number of the things, a number of the trends and issues that we think are most important. So I'm going to talk to you a little bit today. We're going to have our City Treasurer, Tammy Queen, talk about credit. I've got the Controller here today to talk a little bit about the fund balance situation, and then we'll also talk about long-term liabilities. But those are really kind of some of the structural foundational issues that we really need to work on so that when you get ready to set your service plan and do your budget, you can be assured that we're also working on the foundation, ensuring that you have the resources necessary to follow through.
Mr. Landis, if you don't mind, and I've been rude because we have some guests with us today that were not properly welcomed, if you don't mind if
Absolutely.
I take a moment to do that. We have some folks from Socrata. Where are the Socrata folks? Stand up, please, so that the camera can see you. Thank you very much. Would you introduce yourselves briefly, please?
I'm Jesse Romine with Socrata, and very happy to be here. Thank you.
Tell us, and as you're going through, tell us what Socrata does a little bit, so that the folks watching on TV won't know what Socrata is or what you do. So please give us a very brief explanation.
Certainly. Socrata is a government solution provider. We have an open data platform that the City of Kansas City is a current client and leveraging in a partnership. We also have performance dashboarding applications that we're here to talk about as well. Yeah.
Okay, thank you.
And my name is Beth Blauer. I actually, up until August, worked for the state of Maryland for Governor Martin O'Malley, ran his STAT program. So I'm now working at Socrata, sort of making tools for STAT programs and consulting with STAT programs and across the country through the leveraging of open data.
Thank you.
Hi, my name's Jackie Gao, and we're with the Socrata team, but actually with our own company, Localisto, that has a mobile software application and suite that scales public outreach and community involvement.
Fantastic, thank you. Are you local?
Barrett, right?
No, from Seattle.
Okay.
As well, yeah.
That's close.
Yeah. And I'm Barrett McBride with Localisto also.
All right, thank you very much.
Thank you.
And we also have some very new friends who are going to be with us for a while, eating our food and staying in our houses. From Code for America, would you guys stand up, please identify yourselves for everybody, please?
Good morning. My name is Ariel Cannon. I'm one of your 3 Code for America fellows. I'm a designer by training, really working with how people interact and use technology. Code for America is a nonprofit based in San Francisco. We're 3 of 28 fellows this year that are working in 9 communities across the country. And Kansas City is really unique that we're both working with both 2 cities, Kansas City, Kansas, and Kansas City, Missouri. So we're really happy to be here. It's a new challenge for us. And we work and collaborate with governments and their local communities to create new civic tools.
Thank you.
My name is Andrew Hyder. I'm an urban planner and a software engineer from San Francisco, California. Over the last couple of years, Code for America has had a bunch of successes with their fellows in the cities. A good example is in the city of Philadelphia last year. The city really wanted to engage with communities a lot more using technology, but only about 50% of people had internet connection. So the fellows developed some technology using text-based SMS on the cell phones, so the government could ask questions up on billboards and bus stops, and people could type and answer. About 90% of the people have cell phones, and it was so successful that it's actually turned into a small business with other communities around the country.
Thanks, Andrew.
I'm Allison Jones. I just moved to San Francisco from Boulder, Colorado. And my background is in the nonprofit world. I worked for the past 10 years managing volunteer programs and just recently learned how to code. And for this year, the fellowship program that we're doing, it's an 11-month process. We just started in January. We had a pretty immersive training in San Francisco for a month. Now we're here in Kansas City for February, and we're trying to do as much research and observation as we can to meet with people. And then we're going to go back to San Francisco in March and distill all that information and decide what we're going to build for the rest of the year.
Thank you very much. Appreciate it. I should point out that Code for America sent us their A-team with Allison, Ariel, and Andrew. And that Andrew is modeling the latest San Francisco fashion with the tie that's not quite cinched up. And it's all good, Andrew.
Welcome to Kansas City.
Mr. Mayor, we should also probably welcome our new Chief Innovation Officer, Ashley
Is
Hand.
Ashley here? There's Ashley, another part of the A-team. Ashley Z. Hand. Ashley?
Good morning. I'm the new Chief Innovation Officer. I started yesterday, so I'm very excited to get to work, and I'm in the information gathering stage of my time here, but I'm very excited to work with everyone, and I look forward to today's presentation.
Thank you, Ashley. Another A, by the way. So we've got straight A's.
All right.
Tough act to follow, Mr.
I know.
Landis.
And now we have the exciting dive deep into the financial foundation of the city. So
Thank
here
you.
we go, Mayor.
Let's dive.
Our first item to consider is the priority that was set by the Finance, Governance, and Ethics Committee to adopt a structurally balanced budget by 2015-16 to adequately fund basic services. This has been a long-standing goal. This is a pretty normal goal for any city. The trick is, how do you define it? And if you can look at the slide on the right, you can see This has been the city's definition of a structurally balanced budget that we've used, and I believe the city auditor had included this in his review of the budgets over the last 10 years or so when they were still doing that annual review. The first item that we typically focus on is having current expenditures equaling current revenues. And we actually will show you a graph on that in a minute. But the city has been struggling over the years, obviously, because we have more wants and needs than we actually have revenue growth. That hasn't always been the case. If you took this graph back, 10 years or so, probably beyond this particular graphic, you would have seen in the late 90s, mid to late 90s, revenue growth that probably outpaced the expenditure growth. And typically that was the case when earnings tax was hiking up as the economy was hot at that point in time. But you can see on the graphic here that we're actually having revenue growth below expenditure growth, and that basically says, we're having to do cuts in services, or we're having to use fund balances to actually meet the service levels that we're actually putting together each year through the budget. Additionally, what this chart does not show are the things we're not paying. And I think the pension discussion that we'll have later, we'll put a laser on that. But, the rating agencies look at this particular level or this piece of structural fund balance, and they really focus on, do you have recurring revenues that enable you to meet your recurring expenditures? And they include all the things you normally should be paying for. And if you have obligated yourself to a certain benefit level on your pension fund or your OPEB, or you have a certain level of infrastructure maintenance that you intend to maintain, those are recurring expenditures. But this graph doesn't really tell the story. When you looked at the fiscal 14 budget this year, you'll see revenue growth in the general governmental activities outpacing the expenditure plan that we put forward in the submitted budget. That's great for this year, but then you'll also see something in the management letter that says, but we still have a structural problem. We're not paying our pension. We're behind on infrastructure. So this is something that...
Excuse me. We're not paying our pension
Excuse me.
Yes.
We're not paying our annually required contribution as calculated by the actuary. Good point, Mr. Mayor.
Thank you.
Pensioners are getting their full benefits paid. The trusts are adequately funded, and
Right.
nobody should worry that they're not going to have their benefits paid. It's really a matter of adjusting budget resources to the plans and making certain the plans and the resources fit over time.
Right. Thank you very much.
So this is an ongoing issue relative to structural balance. It's something that we're chipping away at. The city has a requirement per state law to have a balanced budget, but we're really looking at that structural balance to make certain that we're really covering the recurring expenditures. Another item, again, is to maintain fund balance at the appropriate level. And Eric will talk about that in a minute. We're making some progress in that area. We'll talk about capital at a later point as well. We are making progress. The budget does show an uptick. But really, focusing on this matching of revenues to expenditures, that's something that we continue to work on. So if our goal is articulated, having this completed by 2015-16, that's going to be a tough goal to meet. And I think working on the definition of what we think is structurally balanced and then having a multi-year plan to get there is really what we need to do in the next year or so. So meeting the requirement to hit the target in 2015-16, unlikely to happen. Having a plan in place and a long-term financial plan to do it over time is probably what we need to work on.
Mr. Landis, if you could, just for educational purposes, each of these slides or panels has in the upper right-hand corner a trend. The first one was the expenditure and revenue growth, and that was a negative trend. And then the liquidity of ratio of cash to short-term investments, et cetera, is a watch trend. Would you be so kind as to explain what those mean?
Absolutely. We use the ICMA financial indicators report, and we dug out a number of trends for the city to put in this financial trend monitoring system that we prepared over the summer. I think we did a little less than 50 that I think there's probably more like 150 in the book. And we picked those that we thought were most applicable to the city. Each of the trends is rated either negative, positive, or watch, and they're rated based on the methodology used by ICMA. And what you're going to hear from us is sometimes you will look at the graph and you'll say, gee, look at that liquidity graph. It would appear to me the trend from 2009 to 12 is positive, but the trend for the 10-year period is negative. So effectively you sort of have a little bit of a split decision on this one, and that's why when you rate it, it's rated a watch. With regards to the expenditure and revenue growth, you can see over time it's a negative trend because we're really outpacing our revenues with our annual expenditure plan. And you're going to see that trend by trend that we've rated using the ICMA methodology.
I imagine that as we get deeper into this, you'll be able to tell us specific areas where our expenditures are pushing us ahead of our revenue. I'm not, but that's coming up, right?
Yeah, we can talk about that, Mayor.
Okay,
Absolutely.
Thank you. Appreciate it.
And again, this is really just focusing on the first goal, and these are the measures that we picked out of the monitoring system to sort of focus on. And then each year when we come back with an update to the monitoring system, this will give you sort of a place to benchmark and figure out what do you need to do, how do you need to monitor, and maybe recalibrate the plan each year. Okay, so moving on, we have another one more trend. Keep going, Kate. This is another trend that the rating agencies focus on, and again, for us, this is a surplus or deficit in operating trends, and a lot of times the rating methodologies will tell you if you have deficits in operating funds that are recurring over a multi-year period, that is a reason to look at the credit and to consider it within the entire credit rating structure. But this is not obviously a positive trend to be drawing more money than you're spending. Okay, and again, this covers operating funds, which is a whole host of funds. It's not just the general fund. We're going to talk about the general fund in a minute. Okay, let's talk a little bit about fund balance. I'm going to have Eric talk to you about the work that we've done on fund balance. Am I too far? Okay, nope. Go ahead.
Good morning. Eric Clevenger, Finance Department City Controller. Back in May of 2011, the council adopted the city's fund balance policy where we are going to establish our goal of 2 months of regular operating expenses as a fund balance in the general fund. Now, when you look at our general fund right now as a percentage of expenditures, again, it says a negative trend under ICMA standards. But if you look back, we actually adopted it in 2011. But from 2009 forward, you can see we have been adding to fund balance generally every year. So now with this fund balance policy that's been adopted, we've established other procedures and requirements before that use of the fund balance can actually be tapped into. It takes council approval before we can actually get into that. Going on to the next slide, we're looking at, again, other operating funds of the city. And again, under ICMA standards, this is a negative trend. But remember now, these are other funds that provide a lot of our capital, other specific operations with the city that should be used first before the general funds are actually tapped into. So in my mind, when you look at these percentages or this level, it's going to fall to a certain level, probably maintain at that, because we are actually putting, again, more money into fixed assets into the city, improving the infrastructure, things like that through these other funds.
Well, and Eric, I think we want to hit on that issue. The reason we were 2003, 2004, 2005, all the way through there, we had significant unspent capital improvement reserves for projects that had been languishing for years and years and years. One of the issues that we did was focus on getting those projects delivered. We now can deliver projects significantly faster than we did just a few years ago, and that's one of the issues of these were fund balances that were committed to projects that had not yet been delivered. And I think that's an important distinction, that these reserves were really there but had been committed to actual projects, and because the projects weren't being constructed on a timely manner, we were building, it was really a false reserve, if you will.
So let me ask a question, because that frankly is a little confusing. First, when we're talking about 2 months of operating expenses, in real dollars, how much is that?
It's roughly about $70 million.
$70 million, so we spend about $35 million a month on operating expenses. All right. Secondly, what the manager just said indicates that for some, it would seem to me that that's almost like mixing two different piles of money. If you have a fund balance, which is essentially your piggy bank, your rainy day account, your savings account, but then you've got capital expense money mixed in with that, that seems like you're going to get, a false picture in that you're mixing apples and oranges. And then if the rating agencies are looking at your fund balance and you've got money that's not permanently assigned to your fund balance, then you're going to get a different picture. Where am I?
I think you're on to something, Mayor. Here's the challenge for Kansas City. We focus on the general fund as most cities focus on their general fund, but because we have so many dedicated special revenue funds, when we go and have the broader discussion about the city's credit, and you go back to that graph we showed you on liquidity, we have a great amount of liquidity because we can draw on the actual cash in the other funds, and as long as we pay it back, we have the ability to pay our bills in a fashion that is maybe beyond what the general fund can do by itself. So we like to have it both ways. On the one hand, this trend, the trend showing the operating fund balances declining, that's a good thing because that means our fixed assets on our balance sheet are increasing and we're investing in capital. On the other hand, it means that we have less liquidity because we have less money in the bank that we can point to and say, well, look past the general fund rating agencies. We got more money behind that. So it's kind of an interesting discussion. So we played it both ways. On the one hand, we'll say 5 years ago, hey, look at all this money in the bank. And now we have to say, hey, look at all this money we spent to put into productive use.
And it's one of those issues that we have had a constant battle with the credit positions because other cities will dump their unexpended capital improvements funds into their general fund and report a significantly stronger financial position. We don't. We segregate our capital improvement funds, report them separately from the general fund. Our general fund unreserved funds are truly the unreserved funds. There's not any commingling of unspent capital improvement dollars. So this gets into that apples to apples comparison between us and other cities. If we had set up our accounting structure, but we wanted to show our residents when we passed the capital improvements fund that it would be separated and segregated from the rest of city operations. So those reserves, which roll at about $90 to $100 million a year of unspent capital improvements as projects come, if you picked them up and dropped them into the general fund, our general fund position would be reported on a snapshot basis of a lot stronger financial position. I think if we can get to 2 months reserves in the general fund and keep doing what we're doing in the capital improvements fund, we'll actually be in a stronger position vis-a-vis our peers because we'll have solid reserves and not commingling of unspent capital improvement dollars.
Well, can't the rating agencies see the difference, or do they just take it at face value?
Well,
we have
they have rating methodologies, and they want to compare city to city. And for them, they're going to laser focus on it. And then we have to tell our story. We're going to tell the Kansas City story about subdividing funds and special revenue funds, and we have a back door to the capital improvement fund by virtue of the way the state statute is written. So it's a long story. And the problem is they change out rating analysts every year, so we have to tell that story over and over. But I think the point Eric's making, and Troy, is this is why we have to focus on our general fund specifically and why it's so important for us to continue to show measured steps and progress toward getting to our goal. And Eric's going to maybe wind up on that.
What we've done in 2013, the adopted budget, we approved $1 million increase to the fund balance, and we've also included $1 million increase to fund balance in the submitted budget for 14 right now. So we're still working on and focusing on this fund balance policy of building that reserve as we go forward.
And then as you think about the long-term financial planning, again, if we have that platform that we built over the summer to talk about next steps, how do we really want to attack this fund balance problem? You heard what Eric said about you need another $35 million to get to $70 million. Well, if you want to do that over 5 years, that's a pretty big chunk of change coming out of the general governmental activities that you would have to commit to. So I think we're doing the right thing. We're showing the discipline. We're making additions. Are we doing it fast enough? That's something we have to decide and weigh with our other issues. Councilman?
That was one of the big issues in the approval of the budget last year, because what we approved was a $1 million increase, and we had considerable debate about that. But $1 million a year means we'll catch up in 35 years. It's very difficult in the budgeting process to give that high a priority when we have so many unmet needs in the city. And I'd just like you to comment on the pace at which we're achieving this goal and whether it's reasonable or...
Well, we're maintaining our AA credit rating. two of our outlooks are stable. One of them we're hoping is going to change from negative to stable, hopefully this week. We're working on a surveillance with one of the agencies.
Is that where the bottle went?
Yes. It was a tough Friday afternoon. Now you forgot what I'm going to say. But the credit rating is not just the amount of debt we have. It's not just the fund balance. It's the economy. It's management. It's all those steps that we're taking. So I think, again, what they want from us, and you'll hear later when we talk about S&P's, Standard & Poor's, 10 management characteristics. One of them is to develop a multi-year plan with measurable benchmarks that you're going to achieve over time. And, again, I think that's what we keep telling everybody. You're not going to solve fund balance overnight. You're not going to solve pension overnight. You're not going to solve infrastructure overnight. Have a plan, do it incrementally, and demonstrate that consistently each time you go for a rating or surveillance.
Yeah, and I would point out that, I think a few years ago, our reserve levels in the general fund were as low as 2.5%, and that was and that was a reported number, and mass ambulance was actually, we were significantly ramping up our operational subsidy for that. There was a time, I think, at one point we had committed more than we had in reserves as part of that issue back in 2005, 2006. We are one of the few cities of this size that added reserves during this economic downturn. So we did it in a slow, measured, consistent pace. I think it's one of those issues from a financial planning standpoint. We are doing it in concert with all the other needs and objectives of the city. So I think we have to continue that effort. We have to continue to be cognizant to put additional monies into reserves, be frugal on the revenue estimates so that if there is upward potential, it accrues to the general fund reserves, continue to watch those expenditures, but it's going to take a measured process. And it was only until 2011 that we went to a 2 months expenditure. For years, it was 1 month or 8% expenditures. And it took us the better part of a decade to get to that number. So it's going to be a slow process of finding the balance in the organization to achieve all of these goals at the same time. But you can't ignore this one. For how many years in the late 80s we operated with $1 million in fund balance in the general fund. Yeah. A $300 million operation, and we were truly robbing Peter to pay Paul during that time. It's way too thin of a margin for a city of this size to have that kind of an issue. That's, by comparison, the 2002 ice storm was a $32 million event. Mm-hmm. That's why you have reserves.
And all of this assumes an economy that stays about where we're at. Obviously, if the economy goes up, gets hot, and there's more revenue flowing into the city, downtown hotel.
Mr. Subliminal.
Then some of these things change. We might have additional funds that we could allocate to the fund balance issue. And the exact opposite if things start to go in a negative way, correct?
Yeah, correct. And that's why we built your fund balance policy the way we built it, because the first month is actually labeled the emergency reserve. Mm-hmm. So the notion is the next 1 month will be counter-cyclical. And if you can see, the rating methodologies will tell you it's okay to dip into your counter-cyclical, and you ought to have a plan to repay it. You want to try and keep that core emergency reserve kind of unscathed as you go through each budget cycle, regardless of the economy.
So right now we don't really have a counter-cyclical reserve.
We just have the emergency right now.
Okay. So, which is one of the reasons why we as council have to be extremely vigilant about not letting episodic, situational needs that seem to have the popular fury behind it cause us to dip into that reserve for any reason, correct?
Right.
Okay.
We want to continue to build, and I think we're on the right path. And the evidence that the council has been making has been approval of these financial policies and then actually using them to put the budget together. And I just also want to mention, as we work through the summer, we're hopefully going to have a fiscal model, a forecasting model that will be usable by this group so that we can demonstrate to you the trade-offs of things like adding to fund balance. Okay, so we've killed fund balance. Let's move on to infrastructure because that's much easier.
Yes.
Our next goal is to ensure adequate funding for the maintenance of city infrastructure. This was also a goal of the Transportation Infrastructure Committee. They wanted us to develop kind of a long-term plan for funding capital at the appropriate level. So this is a shared goal. It's part of a structural fund balance, but it's also part of ensuring that the infrastructure is in good shape and it's repaired timely and it's up to all the engineering standards. Within this particular area, we have this watch trend, which is kind of interesting as you see it going forward. Actually, the trend, I think, is relatively positive. And then as you see this year's budget and what happened as a result of the vote in the summer, we're actually adding even more money to capital improvement. So I think we're doing the things we can do within our means to address the highest priorities, particularly street preservation and street maintenance. And as you look at the percent of the budget, you can see that really it's kind of around 20%. And again, we've not as a city set out a goal of if you just put blinders on and you just looked at all the money, how much do you want to spend on capital? 20% I think was kind of a rough goal for the Community Infrastructure Committee a decade plus ago. I don't know that that's the right amount. It's arbitrary, but you might want to figure out what level of service level you want for each of your infrastructure classes, and then figure out what the funding needs are to get to that particular service level or indicator level. So if you flick, Julie, to the next couple of slides, you can see some of the actual index levels for various systems of the city. We actually have 3 rated systems: the streetlight system, the bridge system, and then the road and pavement or the street condition system. The trends for the street light and system has been positive. And keep in mind, the city made a concerted effort to put a lot of money into streetlights with previous approvals of our sales tax, our capital improvement sales tax. There was a carve out just to do streetlights, to buy the system, to keep it up to snuff. So you can see, the benefit of focusing on an area, and actually, you can see the engineers' rating are suggesting that we're doing a very good job with our streetlights. Bridges are another element of our capital improvement plan that we've actually spent a concerted effort to improve. Again, it's not as upward sloping as maybe you would like, but again, the engineers rate the standard, and if you see the city standard below the line, then you're probably doing a good enough job relative to the resources available to improve that particular asset class. But if you move on to the street system, this is an area of divergence. You can see, based on the rating methodology, and we've actually put a little note at the bottom of the slide, we have a street condition index that we've been using that rates all the pavements, and Pat's back there. Do we do that every year or every other year? Every year. And we're actually not meeting our standard anymore, and that's been occurring for the last couple of years. And actually we have some concerns about it on the financial side, because eventually we'll have to retroactively depreciate that asset class if we don't meet our standard for another year. So we're actually in the midst of having that standard reviewed to determine if we've done something to change that methodology so that it's not reflective of the true condition. And the manager, I know, has a strong opinion about that. In fact, he commissioned the work at our request. So we're looking at this, and it's kind of
the data is good.
It's a little counterintuitive because we're putting more money in. We have a huge street system, as you know, Mayor. But I guess the question is, this gets back into: are we beating up on ourselves? And do we have a job that we've put out there that will never meet our own standard, given the resources that are truly available?
Right.
So we either need to change our standard or change our methodology, or face the issue of retroactively depreciating the whole asset class and having a big negative drop on our balance sheet. So we are at a crossroads, no pun intended, with regards to this particular condition issue. And I think we are making steps to put more money into it, but we got to get this stuff calibrated correctly.
I know that you're not Public Works and you may not have done the deep dive on this, but 2 things. First, if we have to retroactively depreciate the asset, what exactly does that do? What's the real impact of doing that on the city?
Is that a B number?
A what number?
It's going to be approaching that. It's probably going to be around, if we'd have to depreciate retroactively, this would be the infrastructure streets. I'm thinking it's probably going to be around $750 million that would fall from our gap basis fund balance.
Would
We're
certainly.
We're still looking at that, but
And
It's not good.
no, that doesn't seem like it would be a good thing. And then the effect of having to do that on the fund balance would be what in terms of our position as a city with our rating agencies and otherwise?
on our fund balance, I mean, we have, our fund balance policy, remember, is of operating expenditures, and that's going to be cash that we keep on hand. This is actually going to be a reduction of our fixed asset values that we currently have on the books. Under the current accounting standards, as long as we maintain this level that's approved by the council, those assets stay on the books at the same dollar.
Right.
Once it falls below for a period of time, then we either, as Randy was saying, depreciate retroactively to reflect that we are not maintaining our level of standard, or we actually reduce the standard or we improve it so that it's above.
But I think your question is, what's it do to the rating? And again,
right.
The assets are on the entity-wide statements, and really when we focus on the fund balance, we're not looking at the entity-wide statements. So it's going to be a bad thing. You know, we don't want to go there. I don't know that we can tell you what the rating impact would be, because I don't think the analysts typically focus on the entity-wide.
But it does weaken that conversation we always have about the balance sheet,
right?
About the assets and the liabilities. When you start removing assets, you weaken your balance sheet position, which puts you in a difficult financial position to go in and continue to say, I've got my financial position is strong enough to support additional debt or additional assets. So
it limits our options.
Yes, negative net assets on your balance sheet.
So
is what it's
then
gonna look
the
like.
conversations we've been having about the other issue about not wanting things on our balance sheet becomes even more pertinent.
Right.
Okay. Well, that really. What's the timeline for? I mean, when does this decision get made about whether or not there's a retroactive depreciation? Is that something that we're looking at in the next quarter or the next year or the next 5 years?
We're looking at it between now and the end of this year. That's why we're doing the, reviewing the way of the analysis is performed, and we'll have to make some decision. If we don't do anything before April 30th, then the decision's been made. We will retroactively depreciate those assets.
I'm sorry, if you don't do anything before April 30th.
Correct, before the end of this fiscal year.
And the accounting manager, Gary Morris, who's the expert on this from our side, he already has an ordinance in his mind to lower the standard. So he's been ready with his ordinance for a year saying, okay, engineers, either you fix this or I'm coming with a different standard, because we're not going to retroactively depreciate. That's not something we're going to try and entertain.
I guess the next question I've got, and I want to, is, you know, it's kind of like the last election when certain states decided that it would be better not to allocate all of their electoral college votes to the winner, but somehow divide them, and that was seen as changing the rules because you didn't win the game. When we're talking about changing our standards, that's not what we're doing, is it?
We really are talking about changing from 80% in good condition to something in fair condition. And then that gets into is the engineering standard sound? Do we really believe what we're seeing each year with our rating methodology? So that's why we're actually looking at that, because we think there may be there was a change in, I don't know, cartograph or something in terms of the way they're looking at this, and it really needs to be looked at again.
Are those types of rating benchmarks sensitive to the city itself, or is this just some sort of generic application? Because
we've established a stronger standard than other cities have done. And when the standard was put in place, when we did GASB 2034, 2003, 2004, I don't think there was any correlation between establishing the standard, realizing that we've got 322 square miles. For example,
did we just pick up an extra 6? I thought it was 316.
318 or whatever. It's too big for. One of the issues that we've got is we probably set a standard that works well from an engineering perspective, that the street engineers would love to say, and there was no check in the organization to say, is it affordable or is it sustainable?
Right.
Using your example of San Francisco. San Francisco has significantly smaller size,
Right.
significantly fewer, and a lower standard for streets.
Okay.
So we may have put ourselves in an untenable position, just simply putting a standard that we just do not have the resources to make. Now, the other thing that I think is important here is I think there's some data reliability issues, and that's one of the things I'm having the consultant look at, because we have continued to be spending significant resources on street resurfacing. So one of the issues I want to make sure before we come back, we have truly looked at the data, because there was a big change in 1 year that it was not reflective of any. It's not like we stopped doing street resurfacing for a couple of years. We've reduced the amount we had for resurfacing, but it doesn't correspond. So there's something we think in the data.
Okay.
So that's the first step, then come back before the
I believe there was a
council.
conversion, too. There may have been a conversion to a different system in that same.
So we've got.
We're scrubbing it, Mayor.
Yeah, we got to make sure we come back right, but we've got to. This is one of those issues of setting a standard without context of the financial condition of the city to be able to achieve it.
Well, it would also seem like it's setting a standard without context of the city itself,
Right.
Not just the financial condition. I mean, it's one thing to say 80% of 100 miles of road is acceptable. It's another to say 80% of 6,500. You know, and that's just. I would have thought that the standards would be adjusted for city-specific factors, but doesn't sound like it was. But at any rate,
we're going to fix it.
And this has to be fixed before April 30, or otherwise we're in the bad side of the whole deal, right?
Absolutely.
And are we on track to get that done before April 30? Are we confident of that part at least?
We'll have a decision.
Okay. And then you'll come to council with a recommendation?
Absolutely.
Okay. Thank you. Appreciate it.
Obviously, capital expenditures rate very high on citizen surveys, and you can see the circle on infrastructure in the what is it, northeast quadrant of this particular graphic. If you turn to the next page, you can see some of the things that we're doing with regards to our governmental activities. Obviously, we did do the dedication of a portion of the earnings tax, particularly for street maintenance, that's included in the fiscal 14 submitted budget. We continue, Mayor, to talk about the need to have a ongoing capital improvement program that balances the use of pay-go resources with a regular bonding regime using general obligation bonds paid for by property taxes. So the city manager's budget message continues to have that item in it. I know we spent a lot of time talking about it last spring. We talked about $1 billion, and we went a different direction because we had to work on wastewater first. But, you know, big cities that have big infrastructure needs don't use pay-go to pay for everything. They use a combination of bonds to pay for the long-lived assets, and then they use their pay-go to do their maintenance. We have had this upside down backwards since the early 80s. We got so enamored with spending cash for everything that we forgot how to use our bonds, and then we spent all of our bond capacity building things other than infrastructure because we focused on other assets, economic development, convention center, the arena, and things like that. So the best possible situation for us going forward is to look at this capital funding, look at our needs, and then try and develop a balanced plan that you will incrementally include bonds and match that up appropriately with the asset classes, and then use the pay-go to do the maintenance. Now that's, of course, in my ivory tower, it's harder than that, I think.
Would this be a $100 million single hit deal?
It would be an authorization for $100 million. I think that's just an opener for the manager. I don't know. There's no magic to 100. Again, if you ask me, typically you want to go out for as much authority as you can, and then you use it as you're able.
Yeah.
It doesn't go away.
No, once the property taxes increase, it would generate that same excess, hopefully,
right,
over an extended period of time.
Right. Yeah, I won't say we made a mistake. We made a decision, as you know, back in 2004 to issue general obligation bonds without the benefit of using the property tax. That eats a good portion of your budget each year. How many million? 20, 30 million probably to service that debt. And you could have used the property tax to pay for that, but we've been down that road a number of times. And that's the promise that we made, and that's the promise that we continue to keep each year in the budget.
Okay.
Business type activities we're not going to talk too much about today. Obviously, you're well versed in everything that's going on with the water and the wastewater activities, the approval of the bond authority over the summer. We're continuing to issue water bonds. I think you have a sale coming up
in the next few weeks.
In the next couple of weeks. Water bond authority will be down to about $52 million in fiscal 14.
Right.
So there is that issue out there that at some point in the next few years, once you get through the next fiscal year, you'll have no water bond authority either. That's another issue that you're going to need to take to the voters because you do have the needs.
As we look at the water bonding issues, we may need to have a broader conversation about the employment aspects of what happens with those bonds.
Absolutely.
That needs to be looked at seriously. But that's not really your bailiwick. I just wanted to put you on notice. You'll probably need to be at whatever meetings are set up there.
Okay, great. Okay, we ready for credit?
Not really.
I'll let the treasurer jump into this, and
okay.
I will chime in.
Okay, the priority related to the city's credit is to maintain our general obligation AA credit rating and strengthen it in the future by capitalizing on the things that have been identified as strengths and sort of minimizing and addressing our weaknesses as we go along. So we have a couple of indicators that would measure maybe how we're doing relative to that priority. One of them that you see on the screen is debt service as a percent of operating expenditures. Note that this is debt service and expenditures for the general government. It doesn't include anything related to water, sewer, or aviation debt or their operations. So this would just be the general government aspect. You see we have this on a negative trend, and you can tell why. I mean, we're well above the industry threshold, and if you look at any of our ratios, they're all above medians, peer city comparisons, everything. Fortunately for us, that's not the only aspect that the credit rating agencies look at. So we will continue to keep these probably on negative trends. One thing to note, though, is you have your jump around 2006, and mostly that's because of the significant investment that the council chose to make at that time in long-lived assets and to bond for those. So that's the reflection there of debt service increasing. What we've seen, though, is over the last couple of years, we're leveling off. Expenditures are growing, but debt service as a percent of those expenditures is not growing by quite as much. So there may be some positive in that negative, maybe. I'm trying to,
I don't want you to take a firm position on that.
And here's yet another look at kind of another ratio that the rating agencies look at and use to compare us to other cities. This is direct debt service or outstanding direct debt as a percent of our taxable property values. And again, you see the same type of trend. We're well above the industry threshold. We've seen that big bump in outstanding debt there right around 2005, 2006. Again, that significant investment that was made certainly in the downtown area, as well as in infrastructure, because we started really issuing those general obligation bonds. So, the line is flattening. We're still calling this a negative trend because as long as we're above, our median and our peers, then we're going to continue to call it negative.
The general obligation bonds that weren't tied to a property value increase, right?
Right.
So So if we could still do general obligation bonds if it was tied to an assessment against property without the debt service being increased?
It still counts in our debt ratios, but I believe that it would be seen more favorably by the rating agencies because you have a dedicated source of revenue.
You're paying for it. If you issue the debt, you've got a new revenue stream to pay for.
Right.
That's the key.
So it's kind of a net zero.
Okay. Yeah, with the old ones, the revenue source was general fund dollars.
Right.
Okay.
Exactly.
So we robbed Peter to pay Paul on that debt service.
Okay.
Yeah, and keep in mind, we have about $1.6 billion in net direct debt. Only about 20% of it's general obligation debt.
Yeah, maybe even less than that now.
So when you think about debt, we have a lot of debt that's related to specifically voted revenue sources or incremental deals, TIF deals, things like that. And those aren't viewed as favorably. They're riskier. They occupy more budget space, and then they put more stress on the general fund. When you vote a GO, it's the best credit strength. You have the whole area of the city to apply the property tax to, and then you get the lowest interest rate. So it's really viewed differently.
Okay.
Another
Councilman has a
go ahead.
I just want to make sure I'm interpreting the data correctly, because the table shows that the industry standard is 1% of property value, taxable property value, and ours is 5%. That says we're 5 times what we should be.
Correct.
Is it that bad? Or
Yeah, if you look at debt per capita, you look at any of our debt ratios, yeah, they are that much higher than our
alarm you
peers.
that we're 5 times worse than what we should?
It would, I think, well, yeah, it's alarming, but it would alarm me more if there weren't other factors that the rating agencies look at. They are looking at, they still have us, despite the fact that we're way above all the medians with respect to all the ratios that we deal with. Yeah, we still have good credit ratings. We're still maintaining that AA.
Well, does that imply the 1% standard may be unrealistically low, and we ought to be reevaluating that?
Well, again, we don't evaluate it. This is the industry standard. But again, leverage by itself is not alarming. That means that you're using your ability to borrow. You have a highly rated credit to go out and do things. And the city typically was risk averse, and maybe that's part of the reason you have such an infrastructure backlog, is you didn't invest. So we made the investments. The issue, though, is how do you manage that within the context of your economic factors, your management factors, your financial factors. Those things that you control are the most important in that list of things. So, if you elect not to pay your debt and not pay your pensions and not do investments, and you do a bad job overall financially and management-wise, that puts a lot of stress on your credit. So they know we live in a Hancock Amendment state where we can't raise revenues and GO bonds require a supermajority. They know the constraints that we're under. This makes it more challenging,
to say the least. Just
like it makes the budget more challenging.
Yeah.
But we have other factors. We have diverse revenue streams, which is really good. So I'm stopping. You go ahead.
All right. Well, I mean, you see that we still, like I said, we still maintain our AA credit rating for the GO, and then we're one notch below that for our special obligation bonds, which, as Randy pointed out, is the majority of our $1.6 billion in outstanding debt. And as Randy mentioned before, we are on a negative outlook from one of the rating agencies right now. We have been for a year, and that's from Fitch. But we have been working with them over the last couple of weeks, and we hope to hear this week again that, maybe they've lifted that and they're choosing to put us back on a stable outlook. So that's what we're looking forward to, some good news there. Okay, if you would go one more. Yeah. A little bit of warnings, I guess, that we've received from the rating agencies, because, as we said, they look at all those other factors. Some of the warnings are listed up here on this slide. I'll also talk about the positive things to end my part on a semi-positive note. But, they basically warned that if you add more debt but you don't have a dedicated source of revenue to pay for it, that's going to be a problem. That's what Moody's said. Standard & Poor's is still concerned, continues to be concerned about that every 5-year renewal for the earnings tax. Actually, all three of them kind of cite that as an issue. They've dropped it for now because we just got the vote last year that everything was okay for another 5 years, but they will begin to bring that up. What's your plan? What are you going to do about it? How do you propose to address this? What's the contingency if it's not reapproved? So they're going to be looking at that. And then, of course, Fitch changed the outlook to negative, as we discussed last year. But we're hopeful that since, the infrastructure plan that they kind of cited in their report never came to fruition, we feel like maybe we've sold that well enough that maybe they will put us back on that stable outlook. But, they also cite the strengths of the city. And I've got some of the rating reports here, and, they say we have a large and diverse economy. We have closed large multi-year budget gaps in the middle of a recession and added to fund balance in the midst of all that. The 5-year earnings tax, we got a little bit of stability because we got that resolved kind of for the next 4 years now. So that was one of the rating agencies. The other ones indicate that we have a strong economic base. Our financial condition and our financial margins are improving. And again, like Randy said, having a plan and executing, making sure that you're moving toward meeting that plan is really what they're looking at. They're not saying, tomorrow you need to have, your fund balance policy directive, you need to have met that objective. They're not saying that. Have a plan and show demonstrated effort and progress toward meeting the plan. And then finally, the last one, they cite we've had consistent population growth. We've had the ability to expand our population when other cities maybe are shrinking that are like us. And so they also cite our strong financial management policies and procedures. They like that we've adopted all these policies recently. Our revenue policy, our fund balance policy, those are all positives in their mind. So with that, I will.
Before we move on.
Yeah.
I think we need to have you or your team explain the impact of the ratings on the city in terms of interest rates. What is the impact of a negative rating from one of the three agencies? How does this all dovetail together? In fact, in short, these ratings are numbers that are great for us to know, or letters for us to know,
right.
But what difference does it really make in terms of how this city operates financially?
Right. It has every impact in what it costs for us to borrow money. So if we get a downgrade, we're going to pay more than a AA rated city if we get downgraded to A. So there's a credit spread between ratings. So AAA, they're going to get the best rates, the lowest rates. We're at the AA category. We pay a little bit more. In the past, the spreads between those ratings have been very wide. But since we're in such a compressed interest rate environment, it's not been that way lately, and there's really not that much difference between the ratings. But we're going to move back into that environment. All forecasts for the year indicate that interest rates are on their way back up, and those spreads will begin to widen. And the difference between them can be as much as 1 to 1.5% more in borrowing costs per year.
Well, 1.5%, I'm sure that has a dollar sign in your head. What does it mean to us? I mean, when we're talking about a 1 to 1.5% difference in our credit rating, what does that mean in real dollars, and where do those extra dollars come from?
Right. Well, last year, I think for our GO bond issue, we borrowed at around a 3.27, let's say, 3.27%. If it was 1.5% more, we would pay 4.5% roughly, or 4.7. I'm doing math in my head. That's dangerous. 4.7% for those bonds for that same time period. So that differential there is additional stress on your budget. Mm-hmm. So that's more money you have to.
It's over $1 million a year.
Yeah, depending on how much you borrow.
Issue, that's what that.
Right.
So for every $100 million, a percentage point would be approximately $1 million.
Correct.
Per year. Okay. Per year.
Per year.
As long as that debt lasted or until the rating changed.
And actually, if you lock in that rate, it's
done. You can't change the rating from the agencies. Then changing in a positive way 3 years from now would have no impact on it. So We're just locked in. It's like having bad credit and going to buy a used car. You're going to pay more for that car, right?
And there's some opportunity cost issues relative to the downgrade too. And again, if your benchmark rating is your GO rating, and you mainly sell things using your special obligation rating, which is an A, you're starting to slip past investment grade the more these downgrades tumble you down. And that gives you less opportunity. The big deal comes to town, and they want the city to participate in a public-private partnership. And you can't be a strong partner, so you may have opportunities that just won't appear because you can't shoulder up and enable yourself to issue bonds to complement a private deal that you might be pursuing.
And what you're seeing in other cities is other cities, in order to finance infrastructure improvements, Chicago, for example, with their infrastructure bank, is simply they have exhausted their current credit options as a municipality and now are looking at private capital to fund infrastructure investments. There, instead of paying 3 to 4% money, they're paying 8, 10, 12% money. So that's where those types of issues get very expensive, is because if you do not have those credit options for those to deal with infrastructure, you have to look at more expensive private capital, and the private capital expects a higher rate of return than tax-exempt municipal bonds. So it's a significant trade-off. If that credit rating slips too much, your only option to deal with some of your other deferred infrastructure issues or your pension obligations or some of those, it becomes very expensive money, and then that becomes even a
bigger drag on the fund.
Right.
Yeah,
and again, that doesn't even speak to just ensuring that you have ready market access, and then the potential if there's a disaster. If there's a disaster, you really want that credit rating to be way up the scale, because then you have a lot of issues to deal with.
I assume at some point in time there's going to be a discussion of the things that we need to do in order to start inching up towards the highest possible ratings.
If we go back one slide, we'll tell you exactly what we're doing, Mayor.
Okay.
The manager and I actually had used this Standard & Poor's white paper about 3 or 4 years ago to sort of prepare our credit rating strategies. And this top 10 list, you'll read through this, and a lot of these things are going to look familiar to you. Focusing on structural balance, that's been key to every budget message for, I don't know, Troy, last 10 years, chipping away at it. Liquidity management, you see the improvements that we made on the ratios in terms of the quick ratio improving, so you can see that. We've been working on that. We have been trying to do a better job doing regular quarterly analyses. You get the monthly financial report, but it's important that we're able to tell you early and often what your financial condition is at regular intervals so you can make any adjustments that you have to make. And I think we've been doing a pretty good job making those adjustments because you're not seeing the fund balance drop off the map at the year end, even when, like last year, we had natural gas tax shortfalls and we had fewer court fines collected and things like that. You see the work that we've been doing on the rainy day fund. Again, we got the policy adopted. We're inching forward each year. Again, continue to make measured progress. The contingency plans, things like that, that speaks to a lot of the issues that we're having to have each year in terms of we have to demonstrate we have a contingent appropriation, you got money in the bank, those kinds of things. So, again, that's work that we can do through our financial planning model to try and build more flexibility into the system. Contingent liability, things like that, that's your pension, your OPEB. We're going to talk about that in a minute. But again, working on those long-term liabilities, having a plan, demonstrating a plan, making progress, that's very important. And I think we are making progress, and we'll talk about police and civilian pension in a minute. A multi-year financial plan. Does this sound familiar? Again, we worked all summer to develop the trend monitoring system, the platform for the model, and then a series of strategies and recommendations on how to make that. And that's what got distilled into these 5 goals today. We've adopted a debt management policy. We have a long-standing pay-go strategy for our capital improvements, and Advanced KC is your economic development strategy. So from Standard & Poor's own list, we're doing a lot of the things that cities should do to manage within their position. I think we are making progress sort of across the board.
Thank you.
Okay, let's talk about pensions. That's always fun. It's not a big issue nationally, just for Kansas City. If you look at our graphic, you can see the funded ratio, and again, the trend is negative. Obviously, the market correction, whatever you want to call it, in 2010 has really cast a pall on pension funding and made this a much bigger issue than it had been traditionally. The city has always done a good job with its budget and with its pension trust funds, ensuring that there's adequate funds to pay the benefits when they're due, and maintaining a very high level funded ratio. That changed, 3 years ago, and we've been digging out of that hole ever since, just like everybody else. And as you know, Mayor, obviously, if you flip to the next page, we're in the same boat that everybody else is. And the Pew Center, which this graphic's really hard to read, obviously, looked at, I think, the top 60 cities and sort of compared their progress in the last few years about whether or not they were making their annual required contribution, and then whether they were in fact maintaining the funded level at or above 80% for all of their plans. If you flip through, though, you can find where Kansas City is, and obviously we're not the best, we're not the worst, we're sort of middle high relative to where we are with pensions, which suggests that we need to do some work. If you read this full report, you will see that cities like Milwaukee, who are 100% funded, over 100% funded, are working on pension reform. So everybody sees, the handwriting on the wall that some of the promises that we make are very expensive to pay out over time, particularly things like automatic cost of living increases. You're really not, through a market cycle, matching resources necessary to make those payments and to continue to meet those promises. So if you turn to the next slide, you can see the work that we're doing across the city's 4 defined benefit pension plans. In particular, obviously the council is very familiar with the settlement agreement that dealt not only with pensions but with wages and health care for the police and police civilian. We have that legislation that's prepared to, I think it's already been introduced at Jeff City, We're starting to work on that and mark that up. But that is a very positive step. We talked to Fitch about that step in the last couple of weeks, and Kansas City's doing what it's supposed to do. We studied with a pension task force for a year. We work with a pension project team for a year through the manager's office. We've developed appropriate actuarial solutions, and we're working on plan amendments that include increased employee contributions, Tier 2 benefit design for new hires, and then really focusing on that COLA, because that's our big cost issue for all of our plans, trying to find a way to make it either ad hoc or budget related and keep all 4 plans under a budget line each year. Right now we spend around $60 million a year to make our payments to the pension plans. Without reform, that number would be about $85 million. So we have a $25 million gap with regards to our annual budget payment toward the plan design that we currently have. These reforms for police and civilian are going to put a big dent in that, and we are at the table currently on the employer's retirement system with Local 500. And keep in mind that Local 500 have all their members in the ERS plan, but they're also members as a result of the MAST integration from Local 42 and Local 3808. So virtually everybody's at the table right now that has not already adopted pension reform, talking about pension reform, and our hope is we'll get through that in the next few weeks, follow through with the collective bargaining agreement, and then quickly be back to the table with the firefighters to finish this out.
You know, and I'm going to play not even devil's advocate. I'm going to set you up with a question because a lot of people seem to think that this is simply a matter of somebody going into a room, me or the manager or both of us, and saying, okay, change game, and this gets done. This has been, from my involvement in it, from the manager's involvement in yours, and I'm sure from Councilwoman Markison's involvement, an extremely complicated, tedious, moving target situation, correct?
It's not brain surgery. I mean, it is brain surgery. It's not Civil War surgery. It is very complex. There are lots of moving parts. And when you're talking about 4 plans, 2 governed by state law, 2 governed by local law, 2 public safety, it's very complex, Mayor.
Well, I think that what I'm really wanting folks to know who may be listening is that this has been an ongoing effort. It has not ceased. We haven't taken any vacations. It's been an ongoing effort, but it has been extremely difficult. And because not only are we negotiating in some instances the issues related to the pension, we're negotiating the issues related to the pension inside a collective bargaining agreement that has parts, clauses, bits that affect the negotiation process and pension specifically.
Right, and if you think about trying to move all 4, of course my goal, which is narrow and not thoughtful, is to have all of them move forward.
You sure you want to say that?
I share my... all 4 of them have to move simultaneously.
Right.
So you're talking about 3 collective bargaining agreements and 2 public safety groups and state legislation. It's not simple, and nobody wants to go first.
Yeah.
But we've got people to go first, and they've actually made strides to go forward, have legislation prepared for the state level for police and civilian, and I think they've set a good blueprint. So now's the time to roll up our sleeves and finish the other 2 and get to a compromise that fits in the budget, that protects the rights and and everything that we've promised to the pensioners and the current employees, and then develops a plan that's affordable and sustainable and doesn't crowd out too much budget space. That's the big issue for the rating agencies is you can't occupy 10 or 15% of your budget space with pension because you got other stuff to do.
Right. Now, would you explain in as clear layman's language as possible the impact of a guaranteed COLA versus not?
Yeah, what happens is, the actuaries look at all the costs for all the plan participants, and then they project them over 30 years. And when you layer in an automatic cost of living increase on the base benefit, that number just grows geometrically over time. So when you bring it back to a current value, you have a liability which is not $100 million or $200 million, it's $600 million. And that's what we're facing right now is half of that $600 million is attributable to the COLA for the 4 plans. So we have to find a way to keep the promises, not violate any contractual law or constitutional provisions relative to what you've bargained for, but then also find a way to make that COLA affordable. What we've suggested is trying to look at the COLA on an annual basis, not project it for the full 30 years, and then see if you can pay it 1 year at a time. That's a bargaining issue that we're currently working on.
And by doing that, then, you take that $600 million contingent unfunded liability off the books so that you don't have that showing up as a liability that you haven't accounted for with a specific revenue stream, and that should help with the rating agencies.
Absolutely. And the discussion with Fitch, one issue was debt that they were kind of focusing on. The other issue is pension. And what's your plan? You haven't been making your annually required contributions for multiple years now. You've elected to sort of stay pat with the way that we fund pensions, and that means that we're falling behind. So they want us to have a house that we can afford the payments for. They want us to demonstrate, this is your plan design, and this is how you're annually going to pay it, and consistently you're going to put that amount in the budget.
Okay. Thank you.
So with that lovely little trip down
pension
land, now we go to OPEB, which is even more kind of out there in terms of long-term liability. Again, this is a relatively new liability that's been added to the balance sheet in the last couple of years. The Governmental Accounting Standards Boards created a new way to torture us and add this additional projected liability that we now have to find a plan to fund. And so I'll try and say this slowly. Our other post-employment benefit liability is the value of the implicit subsidy that retirees receive by virtue of participating in the city's group bid for health insurance. So when you retire, we consider you part of the group. You pay your full premium, but by virtue of participating as part of the group, that creates a liability that Mr. Controller here adds to the balance sheet. And that liability, because again, like any good actuarial exercise, you project it out over 30 years, is projected to grow and grow and grow as people live longer, and a larger portion of our insurance costs will be eaten up or are required to increase because of the inclusion of that group. If you look at the Pew study, you will see most cities have ignored this issue and have looked at it as, hey, that's kind of an interesting issue. We're not going to work on it right now, primarily because they're like us, they're working on pension. Pension's been a long-established issue, something that people understand. They've created trust for this reason to pay these costs, and they really are beginning to do substantive work on pension reform. OPEB, on the other hand, is still relatively new, and I don't think initially people were, how people kind of come out of the woodwork. Every financial guy showed up and said, hey, we'll create a trust for you. Just start dumping money into it. And I don't know that too many cities really take that approach. I think they're sort of looking at it as, how do we find a way to not fund this implicit liability? On our case, some cities it's a real explicit liability. They really pay for part of the retiree health care. But for us, how do we work on chopping the tree down as opposed to tending it? And this would be by doing reform that says we're going to wean ourselves off, including that group, in some thoughtful way. The manager in his budget message last year had a suggested means of doing that, maybe a 10-year phase out or something like that. I don't know that we've really come to an exact science on how to do that yet, to the point where we'd bring you back a recommendation. But our plan would be work on the pension, develop a complete solution for pension, and then we'll be back to you to talk about OPEB. And again, only 6%, I think, in the Pew study of all these 60 cities have actually worked on this and actually funded part of this OPEB. So it's an issue. It's a creeping issue. Left untended, it will become a big issue on the balance sheet, another B number probably in 30 years if you don't touch it. But it is something that we can work on. And I think one of the good things is we actually have had 2 actuarial reports. We've done it every other year for OPEB. And our liability on the city side actually decreased by virtue of the starting of the healthcare trust and the fact that we're doing a better job managing what healthcare costs are costing the city. So again, that's the prevention and the work on a healthier workforce, changing your projected future, and then deciding what to do to include or exclude that retiree subset.
this is wrapped up in our pension negotiations as well,
Yes,
correct?
part of it.
Well, it can be.
Yeah, one of the issues is the COLA
Right.
is a key issue to ability to pay long-term health care costs.
Right.
And one of the mechanisms that I've recommended is that retirees would pay, over a 10-year period, would pay their full costs of their health care costs as a city.
From zero?
Right now, they pay the blended rate, so they would pay a true one, over 10 years would get to 100% of their retiree health care costs. So they would not pay the same blended rates that the active employees do. We haven't looked at this recently, but a few years ago, before we went to the trust, active employees' health care costs were moving at an 8% trend. Retiree health care costs were moving at a 92% health care trend. Wow. So it's a driving issue that we've got now. We've taken the trust helped pull those costs down in aggregate, but our retirees are still a very expensive component of our overall health care costs, and this is getting to those issues, and it ties into if you're cutting the COLA at the same time you're asking them to pay more on the health insurance, it's a double hit. Yeah. And so we've got to figure out a balancing mechanism to come through this issue. Obviously, and we're trying to use people, move people off our plan onto an Advantra, some health care that lowers that cost so they're not fully in our plan. They're in the Medicare eligible folks. But it's really that health care, it's providing health care when folks retire in their mid-50s until they're eligible for Medicare in the mid-60s, which gets to the point of lengthening the retirement age so that you compress those issues. They all fit together to kind of come back to a plan so that you're managing that cost. But it's a bigger number.
How much of the increase in the basic health care costs are tied to the physical condition of the class?
A good chunk of it, yeah.
So then, let me ask this question.
It's trend-driven, yeah. It's claims-driven.
Then is it not to the city's benefit to do everything we can to make sure that when somebody is retiring at age 50, they've had as little health care, as few health care problems as possible up to that point, and thereby keep the rate increases for that individual and the class as a whole down?
We can retire, if they're going to retire, that hopefully they retire in a very healthy state, because that will
So then, think big this afternoon is a good thing.
That's a very good thing.
And I will see you there.
You will.
Okay. We had our binge yesterday with the donuts.
Yep.
It was like
so
a
that's
last
just water and fruit juice for the next 6 months.
It was the last meal. Only thing lacking was pajamas and slippers. Okay.
I think we're going to take a breath here and maybe focus on customer service for a second. Is that us?
That's
or is
next. Oh, who is
that
it?
You. Is that Jean Ann?
No, that's you.
That's us? Okay.
This is, I'll say, this is our cross-cutting priority focused on customer service and city services, the council's cross-cutting priority. And so it's the same priority, but it applies across the board. And so this is how it applies to finance and budget-related issues.
Okay, I get it now.
Somebody's got to do the heavy thinking around here.
We agree with the priority, and we have taken steps to improve some of our processes and our products, among which would be one of the things that we did with this year's submitted budget to you, Mayor, which was to completely redesign the budget document, which Eric is still thanking me for since we decided that like 2 weeks before we were going to do it.
Yeah, he looks happy.
He's not bitter. I think it's a better product. It has a better overall summary to it. The format is something that we feel like we can produce with the staff that we have. We're using a better, more automated process to actually put it together. If you think about the budget that you got last year, it's like 600 hand-tailored suits. Each page was handmade, and now I think we have a more mechanized way to put that together. We changed the way data comes out of the system and data goes into the budget. So some of the complaints that we'll get is, hey, where did everything go? Because this is rolling up the department pages on a division basis, and the reason we did that is that means the machine can do it, and that means that you have a much slimmer budget. But while we did that, we took away detail in the actual department pages, we included what we hoped was a better overall summary up in the front. Hopefully some different cuts that you would see how much we're spending on pensions, some of the things that maybe you could never find in a budget. And then we took the additional step to say, okay, if we've done too much rolling up here, how about we just give you all the line item? Mm-hmm. So this is the step where we partner with Millie, and maybe the Socrata folks can jump in here because I don't know how any of this works really, being silly, to actually do something different and take all the line item data out and put it on the city's website and let anybody that wants to jump in, and Millie will explain how that actually works.
Well, actually, it was the city manager who said, so we're getting a data catalog, can we put the line item budget on? And so we actually loaded up the budget. It was basically in an Excel spreadsheet, and I think that soon we're going to, of course this always happens that you can't log in. But it is online. It's at data.kcmo.org. And every citizen here and anywhere across the country has access to our line item detail. Other cities have done it as well. We ended up using the data catalog as a way where we actually gave the full PDF, and we also gave the line item detail, the city manager's letter, and now we have the budget schedule because starting last weekend we have budget meetings. So that's the information that's on there. Citizens can go online and comment on the budget. We haven't had any comments yet, so we're looking forward to that.
I thought there was one person who found some typos.
There was.
But they didn't enter it online.
Oh.
I think they found typos in the big document, which I believe is going to be corrected and reloaded this afternoon.
And the good part is that it came straight from the system, so we know the system's wrong, the document's right. So we got to fix because now the system loads things in for us.
Great. And I think we're good with that. We don't have to show it. People can go online, data.kcmo.org.
Well, imagine, if you will, 15,000 lines of mind-numbing budget detail. And you can sort it any way you want. You can sort it by department. You can sort it by fund. Anything that you want to do, that you want to find, you can zero in on a particular line item. If you just want to know what pensions cost in the city, you can go figure that out as a citizen. You can bring it over and cut it and put it into a spreadsheet and manipulate it. So we found it useful as a tool just for us who work with it every day. So who knows what people will figure out and maybe what trends will emerge. I think initially we were a little worried that you would expose all this and you're going to find odd-looking line items. So I suspect that will come at some point, and they'll say, what's Troy's slush fund, 102? Why is that a line item? And so we'll figure that out.
Which doesn't exist, by the way. That was just an example.
It's just a made-up thing. Don't look for it on line 5023.
And we should say the actual, we were trying to link into the analytics part of the site, which is why there was a login. And basically all that would have shown is, it's kind of neat because it shows the actual spike up in access on the day the budget was released, and another smaller spike actually last Saturday during the budget hearing. So that's the only thing we were going to demonstrate. But the actual data catalog is open. There's no login needed. It's just data.kcmo.org, and this is what you'll see. And you get a little sense of the analytics here just by looking at the views. So there's definitely a substantial number of people who've accessed the site.
It's a start. I think it's good.
Great.
Okay. In addition, we also, looking at the internal survey results, and of course everybody's aware that there was a large effort undertaken to look at the internal service providers. Now, we fit into that category on two of these items, and you can see under accounts payroll and accounts payable, which are the bar charts at the top of the page. It's good if you don't have a whole lot of red and yellow, apparently, with regards to customer satisfaction. We think that those two services are very responsive, efficient. I think people thought the staff was courteous. It's a relatively small staff. There are probably only a half a dozen people that work in these areas that cover the entire city. The area that did not come out well with regards to what this group is doing relates to training. And that's something that we're going to work on as part of our work plan for the next year, is trying to find a means to, with our limited resources, ensure that people know how to use the system, particularly accounts payable. There was an audit last week in the Finance, Governance, and Ethics Committee talking about the accounts payable system, and it seemed like a lot of the issues that came up in that audit could be solved by virtue of better training on the system. We want people to be knowledgeable of the system. We want them to use it to its fullest capacity, and we don't want them to make mistakes or to do workarounds, which is basically what was happening, what was found in the audit. So we have work to do. I will push on the manager at some point and say, hey, I don't have resources, help, because we want to do this and we think it matters. But we first have to kind of analyze the data, look at where the errors are occurring, and then develop a work plan and then figure out the resource level to support that.
Well, this slide deals with courtesy and professionalism, and there's what are the other markers in terms of citizen satisfaction other than courtesy and professional?
Well, this is from our internal survey, which is our employee survey.
Oh, okay.
So this was looking at all of our internal service providers. There, for each section, each internal service area, there were a series of questions about the services provided. This question, courtesy and professionalism, was asked across the board and for every service area. So that's why we do this comparative that shows, how relatively high finance staff are regarded in the area of courtesy and professionalism. But as Randy said, for most of finance's questions, there was a relatively high level of satisfaction, and employees also had the opportunity to rank which areas they thought should be a priority for improvement. Mm-hmm. And finance was relatively low on the list, also compared to other city services. So,
okay. I think for the most part, the people get paid, and vendors get paid, and the systems work. And I think that the small staff that works on this ensure that the donuts get made every day, so to speak. So they're doing a very good job of that. They're very courteous. They're very prompt. They follow through. But they are a small group, and to really get out into the departments and to do the extensive training to really unlock everything in the systems will require some more effort, maybe some more resources. The last thing we want to talk about, actually, there's one that's not here. I'll talk about two more things. These are advertisements. Obviously, we're working on our RevKC project where we have a go-live date in June of 2013. This is the big change-out of the automated revenue system, which collects the primary taxes for the city, earnings tax, convention and tourism, those that we actually collect ourselves, and will work eventually to include property taxes in the next fiscal year. The rollout is working fine. We're working with Fast Enterprises. They're doing a terrific job. We're on budget. We're on time. We actually went through some legislative changes last week, which were undertaken and reviewed by the Finance, Governance, and Ethics Committee. So what we're trying to do is align our staff resources, get the legislation approved that changes the Code of Ordinances appropriately to enable us to fully use the system once we get it rolled out. And it's going to be a big improvement. There's going to be big improvements for customer service, customer access portal, use of credits and balances and alternative means of payment, anything that you can think of in a modern payment system. This is a best of breed for tax collection, and we're really excited about it. We only do this once every 20 years, and I think this is going to be a very successful rollout. And Tammy is the next victim, since she owns property tax and special assessment collection, and we'll be doing that in the next fiscal year. The last item I want to mention, and Nick was here somewhere. There he is in the back. Nick Hawkins, one of our terrific Cookingham Knoll interns, will be actually presenting tomorrow our CIPFA, Chartered Institute of Public Finance and Accountancy, GFOA, Government Finance Officers Association, planning and what's it called? It's a CIPFA GFOA Financial Management Module. So,
when you can't even remember
I know.
the acronym.
There's too many acronyms. This is another customer service effort in sort of a long-term planning effort that we're undertaking. Kansas City is a charter member of this CIPFA GFOA model community that GFOA has put together. And what it does is it sets out a whole series of standards and best practices for everything from governance to very specific technical management on things like procurement and treasury management and accounting standards and things like that. And it uses this model to assess the city's current practices in a whole variety of areas. We're actually going to be presenting to the council tomorrow to talk about the governance part of it. And it's an online survey tool, not dissimilar from these other survey tools that you see. And we'll be able to go through and we'll look at a whole different sets of constituencies and determine what do we need to work on, how are we doing technically, how are we doing from a governance, how are we doing from an inclusion standpoint, what can we do better for financial management against these best practices. So I think that'll be an interesting process. We have some of our surveys that have been completed by an internal group, which mainly includes people like you see here at the table and folks like us out in the departments. I don't know if the city manager got one or not. Did you? Okay. So we're going to assess sort of those results, and then as we develop our long-term financial plan in the finance department strategic plan for the next year, we'll have a good basis for what we need to work on.
Thank you. Councilwoman.
Yeah, well, thank you. I really want to say how much I enjoy working with our finance staff. We have just such excellent professionals in our finance department. They really are doing. I think the thing that I want to, probably talk to the mayor mostly about is that these plans are maybe 10-year plans. So how important it is to keep, as councils are term limited. I mean, there are 6 of us that are going to be gone in 2 years, to keep people like first termers in the loop, to make sure that we're all continuing on that same path. It's very easy when the economy improves to want to jump to do some big things or some things that we thought, maybe we wanted to do. But, to be very deliberate and resolute in making sure that we protect the city over the long term. So that's a challenge for it'll be for you, because that's over the next term, and you'll have new people coming in, and the tension between wanting to do exciting projects or respond to opportunities, balanced against the need to really have some long range protections. So it's very challenging.
It is, but I haven't told you about my plan to go to the voters to seek extension of certain council people's terms. Certain council people's terms.
We've got some. We've got some very good people who are going to continue to be to understand. But it takes a while. I mean, I've been on finance now for 6 years, and you really become invested in it. But it takes a while to get invested in it, when you'd rather be, spending money doing some exciting things in your neighborhood and that people really get excited about. But I think, and thanks to the staff, we've done a really good job, I think, of explaining to our residents the importance of sound financial footing for the city for the long term. And they seem, at least in the budget hearing this year, they seem to accept that and to appreciate it. But that's really thanks to these types of opportunities to talk about it. And it certainly is something that is not a short-term fix.
Well, you're the chair of the Finance Committee for a very good reason, and it was a great decision by somebody. Some brilliant person.
The wise mayor.
Yes. But I agree with you. And maintaining a consistent posture over a period of time with changing people and thoughts and ideas is difficult, which is why, to the extent possible, we probably ought to try to codify some of these principles in policies that the council agrees, adopts, and accepts, so that it's not a verbal translation.
Yeah, we're doing that systematically, but they're only codified until the next person submits some other ordinance. So we want to make sure that that everyone, that we do it in a way that which we've had unanimous endorsement of all these policies. So I think we've done it in a way that if they understand the implications, it's easier to embrace.
Councilman Davis, did you
just
have
going to say, you're right, Mr. Mayor, she's irreplaceable.
So we're drafting you to stay an extra year. No pay, volunteer status.
Oh, volunteer, yeah, that's.
No, but you've done a wonderful job, and it's the type of collaborative effort between the Finance, Governance, and Ethics Committee and the Finance Department and the Manager's Office and the Budget and Mayor. The collaboration has been extraordinary, and that's
now
why
the
we all
business community as well.
Everybody's on board. For probably the first time in a long time, we all seem to be sailing in the same direction on the same ship, which is a good thing. Did you have anything to add, Councilman?
Just an observation, and after being on the council 2 years, our capability in this area is much better than I expected. I'm just really impressed.
That's for you guys.
Mayor, I want to thank you for all of our new best friends from the Civic Council who's working on this, and the Chamber of Commerce, and now the Citizens Association. So we are so popular right now, it's hard to, the joy I have, saying.
Is that what happened to the bottle?
Yes, sir.
All right. Margaret, do you have anything? No. Troy?
No, I'm good.
I just, Kate, Julie, I just want to thank you because I know how hard you work on this, and I know that during the budget process you've been working extremely hard. I also want to thank you for the tremendous amount of access and the willingness to sit and explain complicated financial issues to someone like me, where it takes 3, 4, 5 times to actually get it. I do appreciate that. I do have one question for you, and that is, well, actually probably more than one. It looks like we have a mixed bag. We have a number of things that we are doing quite well. In a hamstrung environment, Hancock, supermajority votes required on certain things, bad economy, we seem to be performing pretty well compared to a lot of our sister cities. Everybody wants to gripe about our pension problems, but our pension problems are not anything close to what people who have serious pension problems are.
Right.
All right? So thank you for that, and thank you, Manager, for your management of that as well. But 2 things. Number one, how would you describe the overall financial position and health of the city? And number 2, what do you think are some of the things that we really need to watch in order to move forward effectively? For example, it's not lost on me that a large part of our general fund is related to personnel and personnel costs. I'm not suggesting that we trim personnel. I don't want anybody to start panicking, but that is a large portion, and I don't know how that compares to other cities of comparable size, whether we're high, low, about where we should be, or anything else. So could you address those 2 issues for me, please?
Yeah, to start with, I feel like our financial position is pretty stable. Stable with improvement. I mean, we're seeing improvement even in this year's submitted budget with regards to the economy turning. You're seeing earnings tax perk up a little bit. Property tax isn't the drain that it was the previous year. But we just have to be vigilant, I think, is really our issue, and we have to plan ahead. And to me, the thing that's been lacking is, we have this circular planning cycle where we get all geared up for the budget and we talk about it and then we approve it, and then we sort of take time off and then we start that process again. I think the important thing for us is to match that strategic plan with our financial plan, use the metrics that we're talking about right now to measure our position, and then readjust each year. And have a real financial plan that you guys adopt and that we follow. That will help the credit, that will help the budget process, and that will give you the flexibility going forward to take some risks and do the things that you want to do. So that's really what I want to focus on. As soon as the budget gets sunk in the ground, March 28th, we're already working on the fiscal planning model. We're already updating our trends system, and we want to really hit the ground and start talking with the manager and developing the financial plan, because when we took it to the work session for the Finance, Governance, and Ethics Committee to develop these goals, we had a list of 20 goals that turned into 10 goals that turned into 5 goals. Well, we have to turn that around and say, okay, what's the plan? What's the plan that we should give you, and then what are the trade-offs? We didn't get there this year. So that's the work that we need to do, and I think those will be the next steps to sort of improve everything. And again, I know we joke about the business community, and they're very interested in the long-term planning, but we know how politically difficult that's going to be when I say, hey, Troy, I got a date with you in 3 years to punch you in the nose because I'm cutting you out of the budget. And you broadcast that to the world, and then it starts, right?
It starts 3 years before it happens.
Right. So we have to find a way to make it doable, make it clear, and then the prioritization is really, that's always where it's been. That's where it will always be with any budget cycle or any financial plan is how do you pick the winners and losers, and how do you put the vision in place to figure out where you want to be financially and then service delivery-wise.
Okay, thanks. And how do we compare in terms of personnel costs, et cetera, relative to our peer cities?
You know, we actually took that's actually one of the trends. About 70% of our operating costs pay for personnel, and that looked to be kind of like pretty normal amount. But, you know, we see some other cities, and this gets back to budget space, and I know we mentioned that in the letter this year, which is, you know, how much budget space is pension occupying, debt occupying, personnel, and then what's left. I mean, if you want to do more than 20% for capital, you've eaten up all the space with the other choices that you've made.
Right.
So if you put a plan together, you might say, you know, 2 years from now, I want to be at 69% for personnel. How do you get there? Oklahoma City's doing that right now. They have all the elements in place that we sort of want. They have a trend system. They have a performance metrics report. They have a long-term plan. It's a good model. And one of the things they pointed out in their plan this year is we want to be to 67% of operating costs for personnel by year X. So that's what you have to do. It's almost like you need to go to the financial guys and put blinders on and say, you kind of have to ignore what this is going to be used for, and we got to pick how much space you want each part of this budget to occupy, and then plan.
One last thing, and it should be a pretty easy one for you. A lot of us in the room know that there's two numbers in our budget. There's the overall 1 point whatever billion, and then there's the general fund. But for people watching at home who often see a number or it's reported that the city's budget is X, can you explain the difference between the overall budget number and the general fund and what they're used for?
Yeah, we were trying to do that this year with the overview, Mayor, and try and break those pieces apart. Because when you look at the $1.4 billion, the first thing you have to do is take a big chunk out of that for the airport and the water, sewer, and wastewater systems, because they're businesses.
Right.
They have their own user fees. You can't use those monies to provide services like police and trash pickup. So the first thing we do is we take about $350 million. Is it 350 or 400? 400. There's the old budget guy. Right off the top. So now you're down to $1 billion. The $1 billion is made up of the general fund at about $450 million, and then all these special revenue funds for the balance of that. Now we've got $550 million worth of, you can only use that money for this specific thing that I voted for. So you really start crowding into that space of about $450 million, which is the general fund, which can be used for anything. And oh, by the way, you have two heavyweights that sit in there, a $200 million piece for police and over $150 million for fire. So when you start talking about budget flexibility, the enterprise funds, the business type, you can't spend that. The special revenue, you can only spend it for the purpose it's voted, and the general fund is already beleaguered by the fact that you're spending so much money for public safety. So when you start talking about flexibility, there's not much because we've predetermined how all those monies are going to be spent.
And it's out of the general fund after you take out the cost of public safety and other personnel costs that we have to fix roads, shovel snow, curbs, work to meet our obligations for disability under the mandate, trim trees. Well, not trim trees anymore. Or
trim trees. This is not part of the park sales tax.
It's not part of the park?
Right.
Okay. Well, so that's where the balance
Do
comes
code
from.
enforcement, demolish buildings.
Yes. Everything that citizens seem to want come out of the smallest piece of the pie.
Finance staff.
Indeed. If there's nothing else, then I thank you for your time, diligence, and effort on this. And I know that we'll be constantly updated in a number of different ways. Thank you very much for it. Appreciate it. And I'll see you in Chicago. I guess we're going to Chicago for rating. I had so much fun the last time. I'm just dying to go.
One of the guys won't be there that you met last time, so you should be happier.
I'll be happy. Thanks a lot.
All right.
Appreciate it.